Now, today we have the session 2. In the session 2, we'll be talking about keywords in the forex market, keywords in trading. These keywords are important because most times in our setups and signals, we use them there. Now, these keywords can also be called short forms. Now, the first short form and the most popular short form is TP. We have TPSL. TP is take profit. This is a zone or a place where the market takes you out or a trade of a trade. It takes you out on a trade in profits. And stop loss is a region or zone where the market takes you out in loss. This is very important. In every of our trade, we must use this because most times you can lose all your funds without using this. Now we have money management. Money management, short form here is Now we have break even. Break even is another important factor in our forex market. The short form is BE. Break even is used when the trade is on profit. Now what is break even? Break even is simply moving your stop loss to a profit zone. As you commence trading, you understand this more. Like when you have a trade running in profit, now break even means changing your stop loss, which is the area the trades take you out in loss, to a zone of profit. Maybe moving it to your entry point or above your entry point. Now you have support and resistance. Support and resistance, supply and demand. The shortcut is SNR, SND. Support become resistance and resistance becomes support. You know the more meaning of these ones when you get to the technical analysis level. I already did up the technical analysis course in the group. You can still check it out. Now I have margin call. Margin call is also total loss. That's MT. I have cut loss, which is CL. This is when the trades are invalidated or the zone is no longer valid. Now we are advised to cut loss, so we won't have much losses. Now we have pending order, PO. Pending order, there are different pending order in the market. We have a buy limit, we have sell limit, we have buy stop, sell stop, buy stop, and buy buy stop, buy limit stop. Yes, have buy limit stop and sell limit stop. That's the pending orders we have. We have layer. Layer is an area where you too can enter in the market. Now we have tier, which is trend line. Normally we use all these terms in the forex trading, so you have to bear these terms in your mind. Now let's interest. Like any other commodity bought and sold on the open market, currency pairs are traded either for investment, speculation, or as a medium exchange. In this sense, currency rise and fall because of the supply and demand. For example, the Euro USD rises in the value when demand for Euro rises or supply falls. Likewise, Euro USD declines in value when demand for Euro falls and supply rises. No matter what other factors are in play, the forces of demand and supply will ultimately dictate the direction of the currency. This means that supply and demand are the most important factors that always move the market. Now, as a forex trader or a beginning trader, you should know where the supply zone is and the demand zone are. That's also the support and the resistance zone. Now, to place a trade, you need to determine whether to buy or sell a currency pair. When you buy a pair, you are essentially buying the base currency and selling the quote currency. For example, buying the EUR USD is buying the euro, and selling the US dollar. Buying a currency pair is also referred as going long or longing a currency. When entering a buy position or a long position, you want the value of the currency to rise after you bought it so that you can sell it at a higher price in the future. On the flip side, on the other side, when selling a currency, you want the base currency and buy the quote currency. I mean, when you are selling, you want to sell the base currency and buy the quote currency. This is called a short position or shorting. When shorting the pair, you want the price to fall so that you can buy it at a lower price. Now we buy at a resistance. No, we buy at a support level and sell at a resistance level. We have support and resistance. We normally buy at the support level and sell at the resistance level. Those that follow the class, we know this more. Now we have types of forex traders. We have scalpers. Scalping is a fastest paced trading style where traders aim to profit from all small movements by executing numerous short terms trades throughout the day. Scalpers are somehow the most profitable retail traders if you are good at it, because these traders are good at taking every little profit. They can place many trades at the same time and taking every little profit they get there. So scalpers typically hold position for few seconds. They hold position for few seconds or a few minutes and rely on technical analysis to identify entry and exit points. These scalpers make profits by waiting for price to get to certain level and taking it from there, and waiting for short term to take their profit. Their main objective here is to grab very small amounts of pip as many times as they can throughout the busiest time of the day. This is what the scalpers do. They don't wait for too long. They don't trade the whole day. They just take profits in short seconds or minutes. Now day trading. Day trading is the style where traders open and close position within the same day. Day traders may use a mixed technical and fundamental analysis. This is the best trading style for me. I'm a day trader, so we use fundamental analysis and technical analysis to capitalize on intraday price fluctuations. Day traders usually pick a side at the beginning of the day, acting on their bias, and finishing the day with either a profit or a loss. These kinds of traders do not hold a trade overnight. We might hold trade for hours, but we do not hold trade overnight. Get that? Now swing trading. Swing trading is a style that involves holding position for several days to a few weeks. Swing traders can hold position for a day or some few weeks, seeking to profit from short to medium time price trends. Swing traders may use combination of technical analysis and fundamental analysis as well to identify potential entry and exit points. This type of traders can't monitor their charts throughout the day, so they dedicate a couple of hours to analyzing the market overnight to make their sound trading decisions. These kind of traders are busy traders, and people that always take swings are people that have big currencies. You can see someone that have up to $1 million in his account will be taking a swing trade. Maybe he take a position today and wait for up to 2 weeks for him to take profits. This is a kind of trading done by big men and other financial institutions. Now have position traders. Position trading is a long-term approach where traders hold position for weeks, months, or even years, aiming to capitalize on significant price movement. Position traders primarily rely on fundamental analysis to identify undervalued or overvalued assets, with technical analysis serving as secondary tool. These traders know the fundamental themes will be the predominant factors when analyzing the market, and therefore make their trading decision based on them. So these traders are kind of traders that can hold position for weeks, months, or even years. So they rely mostly on fundamental analysis. Fundamental analysis normally moves the market in such a way that nobody can predict it. So fundamentals, mostly move the markets in such a way that nobody can predict it as well. So these traders use fundamental analysis to predict the market. Now we have terms like spreads. Spreads, this is called a bid-ask spread. It can be thought as the difference between the highest price that a buyer is willing to pay for a currency and the lowest price which a seller is willing to sell it. Therefore, when buying currency, traders will be quoted two prices, the bid and the ask price. The difference between those prices is spread. This is generally how brokers make money. You understand? Brokers are serving us freely. They are making money from our spreads. What's this spreads? These spreads are difference between the buy and the ask price. The bid price is the buy price. The ask price could be the sell price. Now, if you're buying a currency pair, you won't be buying it at the price. You'll be buying it at a ask price. That's it. For example, if a trader wants to buy USD CAD at 1.3530, your brokers will quote two prices, which is 1.3530 and 1.3533. In this case, your long position will be filled at 1.3533, while you are buying at 1.3530. In the particular example, the trader has been charged 3 pips for spread, and this 3 pip spread will be used by the brokers as their own profit. On the flip side, if a trader were to sell a USD CAD at 1.3530, the broker would execute the trade at the level but still charge the spread when the traders buys back the short position. Ultimately, spreads can be influenced by a number of factors, including supply and demand, total trading activities of the currency pairs. Now, sometimes there are high spreads. This occurs in the during fundamentals and during the evening times. When trading with a broker, spreads usually appear in one of two forms, variable and mixed. As the name implies, a variable spread fluctuates throughout the day due to change in market condition and overall liquidity. A fixed spread, on the other hand, remains constant or unchanged regardless of the market condition. And sometimes to get fixed spread, brokers might tell you to be giving commissions. Now, it's too good to use fixed spread because these fixed spreads help in making good profit and helping you while you are waiting for your TP or SL. Now, using fixed spreads sometimes requires you to use high funds in the market, at least $700 or $1,000 in the market. That will be all for today. These terms are the important terms I wanted you guys to know for session 2 of this course. Thank you and have a nice day.